Everyone, and welcome to the webinar. We are waiting for a few more participants to join. We expect to start in the next 5 minutes. Meanwhile, if you guys have any questions about the webinar or if you want to ask anything, feel free to write your questions on the chat box. We'll take it up time to time. We'll start in another 2 minutes. All right. So welcome everyone to your webinar on writing. The agenda for today is to understand how we get started with algos and to understand how algo trading can help us in generating a consistent income. So I'll first go through what is algo trading, some basic details for it. You might be aware of it, but you can take it as a refresher and say, okay, why it is needed, why is it so popular these days. Algo trading differs from manual trading. Then we'll have a quick look at one of our proprietary algos that we have developed in-house and is working pretty well. And we'll also look at a demonstration of one of our strategies, which we call it as a KISS strategy. Before we begin, I'd like to hear from you all. Have you ever tried algo trading before? If yes, what is your experience? And if you haven't tried it yet, then how interested are you in trying it? Do leave your comment on the chat box so that we get to understand our audience. In the meanwhile, let's go and understand what is algo trading and where it can be done. So this is a form of trading, you can say, which can be done on any kind of asset. Normally, if you talk about Indian market, people mostly trade in a couple of asset types. Like they can trade in equity market, where anyone can buy or sell company stocks, which pays you dividends, right? It's kind of like investing in some company, and based on the company performance, they declare some dividends at the end of the year. But you can also trade these shares freely in the market, so you can take advantage of the price fluctuations too. And then there is a derivative market. Derivative market is where you use an asset, derive its price, and then you take a call. So basically, it's not actually buying something, it is getting the right to buy something. Can further be divided into futures and options. Apart from this, the people in India can also trade commodities like gold, silver, crude oil, and all. You can also trade currencies. So legally in India, there are 4 currency pairs that you can deal with. Indian rupee compared to the US dollar, Indian rupee against euro, against Japanese yen, and against the Great Britain pound. There are other forms of assets that can also be traded like cryptocurrencies and all, which falls under the gray area, right? Many companies are doing it, many are not doing it. So there's no clear laws and regulations around it. But what we're trying to understand is whatever asset you want to trade, right? Doesn't matter if you want to trade equity or derivative or commodities, you always have to take a decision. What is the right time to enter into the market and what's the right time to exit? Each of these specific markets opens for a short duration during the day. Right? Like let's say equity market runs from 9:15 a.m. to 3:30 p.m. Commodity runs in the evening hours too. So you'll get a lot of opportunities where you can buy and sell these assets and try to make some profit out of it. At the same time, you also expose yourself to losses. Every time you're going to win a trade, there will be times where you will lose some of the trades. And identifying these buying and selling opportunities becomes difficult when you have a lot of choices. There's a good saying that says spoiled for choices is the most worst thing that can happen. So if you have 1,000 things in front of you, how would you decide to take one of it? Becomes very difficult. Then you take into account a lot of other factors, like how much is the risk associated to something, what is the kind of reward you will get. So a human brain tries to make a lot of decisions instantly, and then you probably decide, okay, this is what I'm going to buy and this is what I'm going to sell. This is when I will enter into the market. This is where I will exit. And as I said, that not every time you will be correct in your decisions. Sometimes you will make profit, sometimes you will make loss. And as per SEBI, the regulatory body for investments in India, 90% of those who trade derivatives, they lose their money. 9 out of 10 people lose. And the average loss is about 50,000 rupees per person. Now take into account the population of India that is trading, and 9 out of 10 people losing money. That means only 1 out of 10 person is making money in market. Only because there are a lot of factors related to human psychology that comes in between a person's profit and loss. And that is where algo trading comes in. Because algo trading is something that removes all the biases that you have in your mind related to certain factors. It removes all the human emotion that comes in between your trades and the profit and losses. And algo trading helps you identify the most optimum entry and exit points so that you maximize the probability for getting a potential profit. So what is algo trading? Why is it so popular? So if you have ever heard the term data science, let's say 5-10 years back, not many companies or individuals were using it. But now it's one of the most popular terms in industry. Everyone wants to learn data science and be a programmer because it is helping take a lot of decision based on the past, based on the historical data. And that is what algo trading also is all about. It's nothing but a program that will take into account what has happened in the past, analyze it, and give you an indication that this is something that might happen in future. So maybe we can take a decision on that. See, market is unpredictable. There could be a lot of things where you can analyze the past and make more accurate predictions. But with respect to stock market, what I have experienced in the last 5-10 years, that market is completely unpredictable. When you predict it's going to go up, it will suddenly fall. When you predict it will go down, it will suddenly rise. There's no certain direction to the market. How is algo trading then going to predict? So algo trading is basically a set of rules that you define. That let's suppose I take an example of one of the benchmark indices in India called Nifty. Right? Nifty is a combination of the top 50 companies in India, Nifty 50. So if I say that if Nifty breaks yesterday's high, I'm expecting it to go slightly up, maybe 20-50 points up. Because it will have gained some momentum to break the high of the previous day. Then I'm expecting it to go a little higher. If it breaks yesterday's low, I will probably go on the selling direction, that it is probably going to continue on that selling trend. That's like a very basic example of one of the rules that you can define. That what happens in the market and based on which, what rules you want to create. So algos are nothing but these kind of programs that you develop based on whatever your experience is in the market, based on what has happened in the past, based on the historical data, based on applying your machine learning and AI knowledge to it. Or it could be as simple as some time-based rules that we are going to look at in the KISS strategy today that can help you develop very proficient algos. Why it is becoming very popular these days? Because it strips all the emotion out of your trades. You'll find traders who enter into a position, and if they are going in losses, many of them do not work with stop loss. They try to keep the trades with them till the capital is finished. But whenever they are in a profit, they'll take only a small profit and exit from the market. They do not hold the trade for a very high profit, but they do hold the trade when they are in losses. That's nothing but emotions, because nobody can see their money going out. So they hold the trade in expectation that the market will come back and they will be able to reduce their losses, which mostly does not happen. So if a trade goes against you, you keep holding that trade in the expectation it will come back, but when it goes with you, you exit from the market by just keeping a small profit where it could have given you a big profit. That's nothing but emotion. And algo trading helps take that emotion out of you, so that even if you are in loss, you need to cut down your losses. And when you are in profit, you should be maximizing your profits, not exiting from the market very soon. And whosoever does trading, they have different trading styles. Somebody wants to, let's say, be a quick trader, enter into the market and exit within the next 1 or 2 minutes. They don't want to keep their trades for long. So within the next 2 to 3 minutes, whatever is the position, like if it is in loss or profit, they will take out of it and look for another opportunity. Someone is, let's say, a swing trader. Swing trader is where somebody buys something today and might be selling in the next day or in a day or two. So they hold their positions for a few days. Or it could be a positional trader, like somebody buying an item today or an asset today and maybe holding it for a couple of months, maybe years. Can be a lot of analysis done on the stock market data, which we call as fundamental analysis or technical analysis. I gave a preview of this fundamental and technical analysis in my previous webinar where we discussed about candlestick charts and patterns. Algos can be developed for any kind of trading style. It can be developed for any type of trading strategies. It can be developed for any kind of time frame, for any kind of risk to reward ratio. So it is completely customizable based on your trading preferences. How do you want to trade in the market? What is your idea of entering and exiting from it? Are you a trader who takes short trades, or are you a trader who wants to take a big risk and ultimately get a big reward? Market goes with you. So algos are these programs that we can develop with programming or without programming. So there is no need of understanding a programming language. You can even develop a algo without the need of any computer program. But if you want to do it, the best programming language we suggest is Python. So algos help you in developing a very efficient automation system where you don't really have to look at, let's say, 1,000 companies' data, or to look at many charts. These algos will automatically identify the right opportunities for you. Then you will have to decide whether you want to take those opportunities or not. But the algos will keep giving you what in the market has the right potential to grow, and probably then you can take trades on that. Couple of years back, algos were not freely available in the market. The brokers that you have in India right now, Zerodha was one of the only brokers that was giving APIs through which we can build algos 5 years back. But in the last couple of years, algos have been made accessible to all, with a lot of new age brokers coming into the market, who are not just offering APIs so that you can build algos, but also they have a lot of other technological advancements which helps even a non-programmer to write a program efficiently and build their own strategies. Not just developing an algo is easy, deploying them is super easy now. You don't need a many technological infrastructure, right? So if you want to do it like for a living and for a big portfolio, then yes, you might need more or a better infrastructure. But if you're doing it on your own, just for your own portfolio, then it's just a matter of having a laptop with a basic configuration and a good internet connection. That's it. You don't need anything else. You should be able to develop your own algo, test it, and deploy it on your own system. You don't need any cloud. You don't need any programming experience. It's as basic as just using a simple user interface and dragging and dropping some things here and there. So how many of, or what do you think is the percentage of people who use algo in India? Can you give me an estimate? What percentage of the trading community, those who trade, I'm not talking about the population of India, those who trade, what percentage of those people would be using algo trading in India and outside India? Can you give me an example of both, like a rough number for both? What percentage of people who do trading use algo in India and US? So in India, I got 1%. Okay. India is 0.1% in, okay, 5%. Yeah, so the number is slightly higher. In India, about 15 to 20% of all the trades that happened are from algos. And this 15 to 20% includes all the institutional investors and companies. We are not talking about the retail traders only. All the hedge fund managers, the mutual fund managers, the big companies who are investing in billions and billions, all these companies and the big portfolio managers, they all use algos for their trades. They don't trade manually. Imagine someone having 1,000 crore rupees of fund. They won't be placing a trade manually sitting on their system. All of their trades would be automated through algos. So which is why 15 to 20% of the total volume of trades generated in India is coming from algo today. And that percentage is somewhere around 55 to 75%, depending upon the region around the world outside India. So you can see India is still way behind in terms of using algo for automating the trades in comparison to the other US, European, or even the Asian countries. You know the country in Asia who has the highest percentage of algo trades? Can you guess which country in Asia has the highest percentage of adoption for algo trading? Answer is Singapore. Singapore has the highest adoption of algo trading in Asia, which is somewhere around 35%. It is still very less in comparison to the US market, which is probably globally the biggest market where trillions of dollars are traded every day. And this number is in India is rapidly growing. As I mentioned, because of the advancement in technology that you see, availability of resources, and more knowledge that people have now, many of them are transitioning to automation because not everyone has the time to sit in front of the system and watch the market for 6 hours. What people want to do is, if they have a full-time job, if they have a full-time business which they want to focus on, they can continue to do that. And they want to use stock market and algo trading as a side business, as something that can generate some additional savings for them by investing some amount. So they don't really have to sit on that system. They can just deploy an algo, which will automatically buy and sell for them based on their defined strategies and rules. And at the end of the day, they can just simply look at the position, what has happened. Or maybe they can just have a look at once or twice during the day to see if the algo is working properly. But they don't really have to sit on the system for 6 hours and monitor their trades. If they have developed a sound strategy, they can make it unattended access. So the algo will be able to do everything on its own. If we compare, how is algo trading better than a manual trading? So a couple of these points we've already discussed, where algo trading helps you automate the trade, so you don't really have to take a decision of buying and selling on your own. While in the manual trading, you have to execute your trades based on your own analysis, intuitions, and experience. Because the market movement can be quite fast, algo trading takes trades immediately within microseconds. When you go ahead and do a manual trade, it might take you about 5 to 10 seconds to place a trade. And within that duration, we've seen that the market changes a lot at times, which we call as slippages. So what algo, let's for an example, say algo buys something at 100 rupees. If you go ahead and buy the same thing manually, you might end up getting it at 110. 110 might be the exit point for algo by taking that 10 rupees profit. And you're manually trading, you enter in that position. So algo trading is pretty quick, very fast. Because even if the market moves sharply, algo trading will be able to give you a right position, which you might not be able to take if you're doing manual trading. You can strip out the emotions from you. So algo trading does not take into account any emotion because these are rule-based systems. Until the rules are met, it will not take any decision. But when you're trading manually, you are greatly influenced by your emotions, your biases, people giving you recommendations around you. Your decisions are very biased on that. Even though you are in the right position and someone comes to you that no, you have taken a wrong position, it's going to go against you, it will start to develop some bias in your mind and you might end up exiting your position, which could have given you a good profit. Because there was a bias, you heard some story from that the market might go against you. So those are the kind of influences that might happen when you're trading manually. Trading, if you are doing it on a large scale, might require a significant infrastructure. But as I said, if you're doing it for your own, probably you just need a small laptop, a basic configuration, and a good internet connection. That's it. You don't really need any programming experience, or if you have a programming experience, that's an added advantage because then you will be able to apply a lot of other techniques to develop these strategies. Okay, so that was a basic overview of what algo trading is, how is it done, and what are the advantages of it. Now do write your questions on the chat if you have any about algo trading, and I'll clarify in some time. Talking about the company, so we are from the Investor Academy, who's recently incorporated in the month of April, but we've been doing algo trading for long. I personally have been trading for the last 18 years. I started my journey in the year 2005-06. And I've been trading since then. I started doing algo trading about 6-7 years back, where I was doing it for my own and for my friends and family. And I started this as a business in 2020 during COVID with my brand Analytical Minds. So you can say Investor Academy is just a sub brand of it or another brand of the same company. And in this, we are going to focus only on automation, developing algos for our clients, deploying them in their account, or if someone wants to invest with us, and also at the same time educate them about algos and how to do it on their own. Just a quick example of one of the algos that we have been using since COVID in our client account. So you can see the result here. One of the algos that we've developed, which deals in the option buying and selling both, where the minimum investment required is about 2 lakh rupees. We can deploy the algo there, and with that you can see the results. Hardly any months where it was in loss since 2020. And on an average, it has generated about 8% every month consistently since 2020, which is way above any other investment that you can find in any asset. But the most important thing is to stay invested. You have to trust the system. It's not like if something is giving loss, you should take out your investment. You have to be invested in the market in order to get consistent return from it. Let's go ahead and see one of a very useful strategy, what we call it as a KISS strategy. KISS is keep it simple and stupid. Sometimes what we think is, if something is very simple, it might be of no use. But if something is complicated, we think, okay, yes, that's a very good thing. So a human tendency or the psychology says we unnecessarily try to complicate things. Something is very simple and is working, why do we have to complicate it? Right? Why do we have to fix something which ain't broken? So it is very true when it comes to stock market. People develop strategies based on n number of indicators, apply machine learning, apply AI and whatnot. They try to complicate things as much as possible, ultimately developing bias about the data. And as I said in the beginning, stock market does not really predictable, right? You can't predict it. If you are able to predict it, then everybody would be a millionaire or a billionaire. It's completely unpredictable. You can get an idea of what happened in the past and maybe try to follow the same path. But what you need is a system which can consistently look at the market and evolve itself with it. Right? Take a case of Nokia as an example. We all know Nokia as a smartphone brand was the #1 smartphones in 2000s, before Android came in the market. But when Android came, Nokia refused to accept it. And within a very short period of time, Nokia was out of business. Right from being #1 smartphone manufacturer in the world to being out of the market in just about a year, because they refused to change, because they refused to evolve. That's what happens with stock market too. So if you do not evolve yourself, if you do not optimize and strategize your strategies, you might not be able to work in the market. Any strategy that you develop needs changes based on the current market situation. We cannot keep working with the same strategy over and over again and make profits. Probably the strategy that is working today might not work tomorrow because the market condition might be very different. Probably something that has not worked previously is working today because everything has changed. So you have to keep changing your strategies with the current situation of the market. Only then you will stay with the current and the latest trend. And that is what this KISS strategy is all about. Keep it simple. So what we are going to do is just look at what is happening in the market probably in the last 2 months. We'll not go into very fast. We'll just look at what has happened in the last 2 months, maybe last 1 month. And we'll try to follow the same. And we'll see the results. If we have done the same, what could have been the result? Okay. So let's go to our backtesting platform first to see how to analyze the recent trend of the market. And then how do we decide to take any trades over it? So I'll go to Python for this. You can also do this with any no-code platforms too. So let me share my screen for Python. So for those who are not into programming, don't worry about this. Just look at the outcome. Okay. There are many other ways in which you can derive the same thing without programming too. So I'm going to download the data for Nifty from the 1st of March onwards. So I'm using some Python program to download the data directly from some source on a 5-minute interval from the 1st of March 2024. So what I'm doing is downloading the data for, let's say, the last 2 months, including April. So what we have is data for Nifty right from the 1st of March till the 26th of April. And the data is on a 5-minute interval. So 9:15 says this was the open, high, low, and close for Nifty from 9:15 to 9:20 during the first 5 minutes of the market. This was the open, high, low, close from 9:20 to 9:25, right? So each row in this data represents the open, high, low, and close for Nifty for that 5-minute duration from the 1st of March till the 26th of April. So I'm analyzing only last 2 months data on a 5-minute interval. Generate some additional information. So the information here I'm generating is the hour. So basically, what was the hour? What was the minute? Like it was 15 minutes. So we had all the things into one column. I'm just separating it out in various columns. So I'm extracting all this information separately in new columns. What was the hour? What was the minute? What was the combination of the hour and minute? What was the year? And what was the month and date? And what was the weekday of it? So the first row was 1st of March 2024, and it was 9:15 in the morning, and it was a Friday. Similarly, the second row was the 1st of March 2024, 9:20 a.m., and it was a Friday. And likewise, we are doing it till the end, which is 26th of April 2024. The last data that is available is from 3:25 to 3:30, and that was also a Friday. So it has generated. So what we have done is we have just broke the first column into multiple columns, right? And then I'm simply plotting it. What I'm doing is I'm simply creating a graph that for all these 5 minutes, right from 9:15 to 15:25, we've generated data for each 5-minute duration. So what I'm looking at is from 9:15 to 15:25, which is from the time market opens till the time market close. What has been the average movement of Nifty over the last 2 months? This dot right here at 9:15, it represents the average of all the 9:15 closing price in the last 2 months. So what is the average of the closing price of Nifty at 9:15 every day for the last 2 months? So I'll give you an example here. What I mean, just give me a second. So basically what I mean here is, say on the 1st of March, the price was 20 rupees. On the 2nd of March, the price was, let's say, 30 rupees. And we are talking about only 9:15. That at 9:15 a.m., this was the price for Nifty. On the 1st of March, it was 20. For the 2nd of March, it was 30. For the 3rd of March, it was, let's say, 15 again. On the 4th of March, it was somewhere around, let's say, 10. Or let's say 15 again. There was no change. So what I'm going to do is take all these days like this and calculate an average. What is the average price of all these days at 9:15? And that is what we are representing here. And we are doing the same thing for the other time durations too. That what was the price of Nifty at 9:20 for every day? Take an average of it. This is the average. Similarly, each of these dots that you see here, they represent the average of the closing price of that particular time for the last 2 months. So what we have here is a very simple technique, right? Keep it simple. I'm not applying any machine learning. I'm not applying any kind of technical indicators or any kind of very complex analysis. What I'm looking at is a basic flow of data. How has the price changed over the last 2 months, right? From where the market starts till where the market ends. So what we've seen is from 9:15 to probably around 10:30 or 10:35, the market is not showing a good movement. So it's not the right time to enter into any position because the market is quite choppy. It is up, down, up, down. It's not really moving in any particular direction. But after that, we see some movements clearly defined, like from 10:35, this point, to 10:50. This 15-minute duration, just the 15-minute duration from 10:35 to 10:50, there is a clear movement that the market has gone down on an average for the last 2 months. We're not talking about 1 day or 2 days. We are talking about 2 months data. On an average for the last 2 months, during this 15 minutes, market has gone down. So what if I sell at 10:30 or 10:35 and I buy at 10:50? Will it give me some profit? Because what I've seen is in this 15-minute duration for the last 2 months, market is always going down. So why not capitalize on this move? So let's go ahead and see if we would have taken a trade here, is it giving us profit or loss? What is the position of the trade if we sell at 10:35 and buy at 10:50? So I'll go to the backtesting platform that we have. I use Stockmark as one of the backtesting platform because it has all the data that we need. Options data is something that is not readily available anywhere on internet. So you have to use these platforms. You will get the data for the indexes, the stocks, everything, so that you can analyze that using Python, but the options data is not readily available. And Nifty charges around 15 lakh rupees every month for giving that data. So which is why it is easier to use some of the backtesting platforms that are already available in the market. So what I'm going to do is take Nifty, because we were analyzing Nifty. I'm going to take an options trade on a put. So I'll quickly give you the differences between a call and a put, right? So there are two types of instruments that you see here, a call and a put. Call is when the market is going up, you buy something and you sell at high. Put is when the market is falling, you buy something and you sell at a low. So in the rising market, you buy a call. In the falling market, you buy a put. That's a basic understanding of the options terms. Since we want to make a downside movement, so I'm taking a put, I'm buying it, whatever is the current market price, I'm buying it at that position, right? And what was the time? We are buying it at 10:35 and we are going to sell it at 10:50. So 10:35 is when I am going to enter into the trade, and 10:50 is when I will exit. So what we are doing is we are taking a put position because put is for falling market. We are seeing the market is falling from 10:35 to 10:50. So from 10:35 to 10:50, I'm going to hold a put without any profit or a stop loss because the trade is just going to be open for 15 minutes only. Let's see if we would have traded this from 2024, the March 1st, right? That's the duration of our test on Python. that from the 1st of March till the 26th of April, if we would have capitalized on this downside move, what would have been the result? This is the result. That the estimated capital I would need to take that trade, the smallest capital that is needed is around 3,300 rupees. And on that 3,300, I would have made a profit of close to 5,000 rupees, which is 145% of the capital. So yes, a very simple analysis of just an average movement of the last 2 months is looking promisable. I would have won 53% of my days and lost 47% of the days. That means out of all the days that has traded, 19 days I would have been profit, 17 days I would have been loss, which is almost around 50-50. Still we are in a profit, because whenever it is making an average profit is 551, whenever it is in loss, the average loss is just about 335 rupees. This is the performance on every day. So let's suppose now I want to optimize my algorithm, that if I deploy this every day from Monday to Friday, it is making profit every day except for Friday. So I get to know by backtesting that this pattern usually does not appear on Friday. It appears on Monday to Thursday regularly, but it does not appear on Friday. So I will not take a trade on Friday. I will remove it. So I'm going to take just a trade from Monday to Thursday, and you can see now the profit has increased. Everything else remains the same. My winning percentage increased from 50 to 60%. That's optimizing your. This was only one duration, just about 15 minutes every day, and one asset, Nifty. We have 6 other indices that we can trade. There is a lot of other opportunity available during the rest of the day. Let's take one more example, that from 10:50 to 11:15, in the next 25 minutes, it's always going up. Is it going to be profitable if I trade this? From 10:50 to 11:15, going up. So if I take a call for going up from 10:50 to 11:15, right? Just a simple strategy of a 15-20 minute trade. Do I buy, do I sell, and test it for that 2-month duration. See, again, the required margin is somewhere around 3,500, and similar kind of profit. Even in that falling market, we made some, and then the next 15-20 minutes, we made something out of it. And now we know that this is not working on Mondays and Wednesdays, probably not on Fridays. So I'm just going to deploy it on Tuesday and Thursday only. So if I deploy it only on Tuesdays and Thursdays, see the amount of profit generated. With the maximum loss of only 650 rupees, and the maximum profit is somewhere around 100% of the margin. So you can see this graph for the 2 months. There were hardly any losses. Almost every time we see a green, that means this was able to make money. The win percentage is around 67%. So 67% of the times, if we would have traded this, it returned a profit. And likewise, we can divide this entire day into multiple breaks, right? Then I can take from probably, let's say 11:45 to 12:10. This is like a downside. From here to here, this is an upside. From this point to this point, this is a downside. From this to this is an upside. So if I take all these trades collectively, let's say I take all these trades collectively, I divided it into 7 different zones. Like this was zone number 1, this upside is zone number 2, then this upside is zone number 3, this downside is zone number 4. So I divided, let's say 7 zones. And let's test what would happen if I traded all day on these 7 zones, right? From the 1st of March to the 26th of April. So I'm testing all the 7 zones together. Remember, the average margin required was just about 3,500 rupees. And if I trade this 3,500 rupees on an average in 2 months, we would have generated this much amount of profit. And if you look at the daily outcome, every day there was some or the other profit made. That means if one strategy is making loss, the other is making a profit. So on an average, we are making something at least every day. If you look at the percentage, the highest money made was on Thursday. So even if I don't use it on any other day, just the Thursdays, I should be good. And this is a result for the last 2 months only, with a very small margin of about 3,000 rupees. This is real data. This is not actual data. This is not a dummy data that I'm showing you. This is actual data on which we are analyzing the trend. And this is the actual data on which we are backtesting and seeing whether it was profitable or not. So even with a very small amount of risk, I go ahead and deploy this, then I can expect at least nothing but 8 to 10% a month minimum, which I showed you in one of the strategies that we've deployed. But this is a very simple strategy. As we know, market is not something that can go in the same trend every day. But we need to trust the system and keep using it for a longer duration, keep updating the trends, keep changing the time, optimize this further to make sure that the losses are minimized, decide which weekdays to trade, which weekdays not to trade, which zone to trade, which zone not to trade. Look at the news for that day. If the market is very volatile, do not deploy. Only deploy when the market is not fluctuating much, or there is no news about something very drastic. So you have to take into account a lot of other things so that you can deploy any strategy. But this is one of those strategies where you can expect the market to give a consistent return if you optimize yourself and if you stay updated with the current trend of the market. No fancy indicators needed, no machine learning need to be applied. With simple strategy, also you can generate good returns. But you have to think about how you can utilize the time, and you can come up with some strategies that can work in any kind of market. This is a strategy that we have seen doesn't matter if the market is going up or down. We have taken a trade in both directions and we are making some profit out of it. There could be losses. No denying that fact that we will make loss. But whenever we are making profit, we are making more than the losses. So over a period of time, we will be profitable. So this was a basic strategy that can be used, might not be used. It depends from person to person and how you are optimizing it, how you are thinking about it. And money management, the risk management is very important. Although we showed that 3,000 margin is required, that could be like every day you are losing 3,000 for the next 10 days. 30,000 of your capital gone before you start making profit. So you need to be very, very restrictive on which strategies you are selecting. What is the potential of that strategy and whether it is going to work on any market condition. If not, try to combine multiple strategies into one. Like I showed you one strategy alone and then a combination of 7 time zones together. You saw the impact. So that is the impact you can create by combining multiple assets, multiple time zones, multiple kind of ideas that you can develop on them, deploying them on a certain weekday and all. So there are many kind of these permutation combinations that you can think of and apply. So that was about what is algo trading and the potential of it. Now coming to the main part, which is about the course and the algos. So as I mentioned before, we have developed a lot of algos in-house that works on any kind of market situation, that works with any kind of capital, that works with any kind of risk profile that a customer has. So if you are interested in using our algos on your account, do feel free to reach out to us. You'll find the link to a form on the chat. So you can fill in that form and we'll get back to you as soon as possible. We can discuss the opportunities that we have. And if you're interested in learning, we do also provide a course on it where you'll get to learn everything right from the scratch. What is stock market? What are the asset classes? Technical indicators, charting platform, a little bit of Python programming. If you are not programmer, if you're non-programmer, then how to use these no-code platforms that that I just used to backtest your data, to develop your strategies. And then we will also be helping you to deploying your strategies on your account. So do feel free to reach out to us in case you have any questions. Write down on the chat. I can answer them right away. And if you're interested in using the algos or to learn more about them, leave us your contact details and we will contact you with more details on them. That was all about the webinar today. Feel free to write your questions. If you have any, I'll take them up right away. Right, I do not see any questions here. So okay, one question. Average can be a bit biased to outliers. So does the median show the same trend? Well, you can look at the median. Let's go ahead and do that. A very good point there. So let's take one time zone from 1035 to 1050. We saw a falling market. So instead of a mean, if we take a median, what would happen? Do we see the same trend? And yes, we see the same trend from 1030 to 1050. See, the market is falling. So you can look at the average, you can look at the median, and then probably you can go with the time zones which are similar across both. But when we are talking about stock market, there is no outlier stuff. There could be some movements based on news, but we don't really consider an outlier in a time series data. It is a time series that we are analyzing. Time series, we do not consider outliers. So yes, average can be used in any case. How the algo works in the sudden market movement of around 100 to 200 points. Recently, a sudden fall and recovery of 100 to 200 points happened. What was the profit or loss percentage at that time? So when the market moves by 100 to 200 points, we have a strict money management. We work on stop loss and we work on target profits. So let's say we are in a buy trade and the market fell 100 points. It would have given us a stop loss. At the same time, if there was a recovery, algo would be smart enough to pick that trade again and close it in profit. So we don't really have an open position without a stop loss. A stop loss is always there. So if the market is unfavorable, we will have losses on that day. But that's something that does not happen always, right? It could be only a part of the day or maybe once in a week or a month kind of situation. So stop loss is very strict, which is what we will take on that day because the market did not favor us. But on the rest of the days, we'll make sure that the profit that we are generating is more than the stop loss that we have given. So this is exactly what I said. You need to stay invested. You need to look at a monthly horizon at least. Do not look at a day wise what happened on a particular day. Look at a monthly movement, right? What has happened in the month? And then you'll get a clear idea of what has happened with the strategies that you have deployed. Maybe it could happen that consistently on 5 days or 6 days, it might give you losses. That doesn't mean your strategy is not good. It means that you have to stay invested, you have to trust. Maybe on the 7th day onwards, you'll start getting profit and you'll recover all your losses in just 3 or 4 days. And that is what I showed in the presentation too. That when you are using any strategy, you have to stay invested and over a period of time, you will always make money, no matter where the market is heading. Since COVID, we have seen all kind of movements. We have seen 1,000 points upside. We have seen 2,000 point downside. We have seen sideways. We have seen sharp movements. We have seen gap ups. We have seen gap downs. So something, if it is working fine for a very long duration, that means it can work in any situation and we can trust that system. It may be that some months it might give a loss, but ultimately it is going to recover that money for you. I hope that answers your question, Viresh. How can I learn the algo trading via Python? So Mahesh, we offer a course for that. Do leave your contact details on the form that is shared and we will get back to you with the details on the course. how you can enroll and how you can start learning it. Can algo work referring to the volume? Yes, it can. Volume, you can say it's just one of the indicators. So you can use volume, you can use, let's say if you're working in options, you can use the OI data, you can use the PCR ratio, you can use the open interest. So there are many other things that you can build into your strategy, and then you can deploy them. So yes, volume can be one of the factors which you can use in order to create your strategies. The questions that we have. I do not see any question on the chat window. So I hope this webinar was useful in understanding how algorithmic trading can transform your trading journey, right? So if you have any doubts, if you still have any questions, I will paste my contact details on the WhatsApp group we have. Feel free to join that group if you have not already. We keep sharing all the results of our algos on a daily basis. I will shortly be sharing the monthly portfolio that we have, right? While I share every day what is the profit and loss we have, I will be sharing the monthly result, right? For the month of April, for one of our clients, what is the live result of their account? So you'll get an idea when we do or when we apply algos, how much you can expect from it. So if you are interested in algos or if you are interested in learning, leave your contact details. We'll get in touch soon. Our first batch is going to start next weekend, and the enrollments we are going to close probably tonight or tomorrow max. So thank you so much for joining in. I will see you all with the next webinar very soon. Till then, take care. Bye-bye. Have a great day.